What kind of investor am I? Understanding your investment style and behavior. Before making decisions in the market, it is essential to ask, what kind of investor am I? This question goes beyond labels like aggressive or conservative. It explores behavioral tendencies, emotional responses, and long-term habits that shape investment outcomes. Research in behavioral finance emphasizes that self-awareness is a critical predictor of success. 1. Behavioral dimensions of an investor. Investors differ not only in risk tolerance, but also in how they react to uncertainty, loss, and opportunity. Key dimensions include risk tolerance, comfort with volatility and potential loss, decision-making style, analytical versus intuitive, time horizon, short-term trader versus long-term investor, emotional response, how fear, greed, and impatience influence choices. Understanding these dimensions helps identify whether your behaviors are aligned with strategy or driven by emotion. 2. Common behavioral profiles. Behavioral finance research identifies several investor archetypes. The passive investor prefers long-term, low-maintenance strategies, avoids frequent trading. The active trader seeks frequent opportunities, reacts quickly to market movements. The risk-averse investor avoids volatility, prioritizes security over potential high returns. The opportunistic investor explores high-reward opportunities, embraces calculated risk. The emotional investor decisions heavily influenced by fear, excitement, or social cues. Many investors combine aspects of these archetypes, but self-reflection reveals dominant tendencies. 3. Emotional awareness. Investing is as much psychological as it is financial. Key emotions shaping investor behavior include fear can lead to missed opportunities or premature selling. Greed can lead to overtrading or chasing returns. Impatience can undermine long-term strategies. Ego can drive decisions to prove oneself rather than achieve results. Recognizing which emotions influence your behavior helps align actions with goals, not impulses. 4. Self-assessment questions. To better understand your style, ask yourself, do I prefer long-term growth or short-term gains? Am I more reactive or deliberate in decision-making? How do I handle losses and market volatility? Do I follow a strategy or act on impulse? Your answers reveal patterns in behavior, emotional tendencies, and investment preferences. 5. Strategic implications. Knowing the type of investor you are allows you to design strategies that fit your style, manage emotional biases effectively, select assets, time horizons, and risk levels that suit your temperament, develop habits that reinforce long-term success. Investors who understand themselves are more likely to maintain discipline and achieve their financial goals. Final insight. Being a successful investor isn't just about picking the right assets, it's about knowing yourself. By asking, what kind of investor am I? You gain insight into your behavior, emotions, and patterns, enabling decisions that are aligned with your goals, temperament, and long-term success.